The Dow Jones Industrial Average inched higher Thursday, helped by a solid performance from financial stocks and strong jobs data. Shares of Dow component JP Morgan Chase got a lift from positive comments from a Bank of America analyst, while a report showed private sector hiring rose more than expected in December. But even that good news was only just enough to keep the Dow in positive territory, finishing up just 0.03%. The same wasn't true of the other major indexes. The S&P 500 dropped a third of 1%, and the Nasdaq fell more than half of 1%, extending its bleak start to the year following a blistering rally to end 2023. Bets that the Federal Reserve could start reducing rates this year had driven much of the gains toward the end of last year, though the latest minutes from the central bank's December policy meeting did not offer many clues on when the easing might begin. Investors remained cautious on Thursday, and a tick-up in yields on 10-year treasuries prompted traders to move away from growth stocks toward other sectors. Penn Mutual Asset Management portfolio manager George Cipollone said investors should pay close attention to the gyrations of the 10-year bond.
There's been about a 15 basis point move up in the 10-year yield just in the first 2 days of the year. 2 to 3 days of the year. And I think that what that's telling me is that the market's going to be hypersensitive now. We have a bunch of economic readings coming out. We had a jobs number today. We have the non-farm payrolls coming out tomorrow. What that's telling me is that the market's going to be ultra sensitive to these readings and how the bond market responds to these readings. So I really think that the 10-year yield is the best benchmark to gauge in terms of how stocks may perform.
Apple stock received its second downgrade of the week, with broker Piper Sandler cutting the iPhone maker to neutral, days after Barclays also reduced its rating. Shares fell 1%, and Walgreens Boots slid 5% after the pharmacy chain slashed its dividend more than 40% to conserve cash amid low consumer spending and intense competition.